So if you look at basically every Fortune 500 CEO right now, they're all absolutely terrified of being left behind by artificial intelligence.
Oh, completely terrified. It's all they talk about.
Right. I mean, you see the headlines every single day about these massive enterprise investments in AI, the race for computing power, the endless software subscriptions.
Yeah, the spending is just off the charts.
Exactly. Yet, if you look closely at the underlying financial data from the companies actually supplying the labor for these digital transformations, there's this massive contradiction that pops up.
A huge one, yeah.
Because these colossal enterprises, they're not actually aggressively hiring permanent AI experts.
Right, they're not.
They are aggressively renting them. So today, we are opening up the Q4 2025 ledger on Kforce Inc.
Ticker symbol KFRC.
Yep, KFRC. And we're going to find out exactly why this is happening. Welcome to a special Talk Tickers deep dive tailored specifically for you, the retail investor.
And it's an important one.
It really is.
Yeah.
Because if you want to understand the macroeconomic labor market, and specifically why the biggest bottleneck in the AI revolution isn't, microchips, but temporary staffing, this specific earnings transcript acts as a flawless decoder ring.
It really is a phenomenal text for diagnosing the exact state of enterprise IT spending right now.
Just a quick reminder on the format for you guys listening. Usually the Talk Ticker style is data forward, plain language, opinionated, and exceptionally concise.
Yeah, we usually target that fast-paced, under 5-minute style breakdown.
Right, but today is a special expanded deep dive. We're really going into the weeds. So Kforce operates as this premier professional staffing services and solutions firm, right?
Yeah, leaning really heavily into technology and finance and accounting. F&A.
Okay, so we're looking at a company that basically acts as the primary labor conduit for the world's largest corporations.
Exactly. When Kforce reports their quarterly flow, they aren't merely giving an update on their own internal operations.
Yeah.
They're essentially publishing a real-time heat map of enterprise capital expenditure on digital transformation.
A heat map. I like that. Mm-hmm. And the context here is really what makes these Q4 numbers so critical for you to understand.
Because of the timeline, right?
Yeah, because we're looking at the potential end of a grueling 3-year macroeconomic tech sector stagnation.
It was rough.
I mean, we endured the post-pandemic hiring mania, then the subsequent whiplash of the Great Resignation.
And then just a prolonged, stubborn freeze in tech labor mobility. Nobody was moving.
Right, exactly. So the thesis we are testing today against Kforce's data is straightforward. Has the ice finally broken?
That's the million-dollar question.
So let's dive straight into the ledger. Let's hit the headline numbers.
Let's do it.
Q4 top-line revenue hit $332 million.
Which is a definitive beat against their own internal expectation.
Right. But we have to contextualize that $332 million against the broader annual picture, don't we?
Yeah, we absolutely do. Full year 2025 revenue came in at approximately $1.3 billion.
Okay.
Which was actually a year-over-year decrease of roughly 5%.
Wow, 5% down for the year.
Yeah, so you have this macroeconomic environment that kept the full year numbers suppressed, which totally validates that 3-year stagnation narrative we just talked about.
Right.
Yet the final quarter of the year breaks the trend line and exceeds expectations.
Meaning a potential momentum shift heading into 2026.
Exactly.
Okay, so a strong top-line finish for Q4. But if we move down the income statement, the bottom line tells a much messier story.
It gets a bit complicated here, yeah.
Because Q4 GAAP EPS landed at 30 cents and adjusted EPS was 43 cents.
And that adjusted 43 cents actually fell below the midpoint of their guidance.
Wait, below guidance, so they missed on earnings.
They did. Full year 2025 adjusted EPS sits at $2.09, which is an approximate 22% year-over-year decline.
Ouch. And what about margins?
Overall gross margins for the quarter were 27.2%.
Which represents a 50 basis point sequential drop, right?
Yep, a 0.5% drop. That divergence is the primary puzzle of this entire earnings report.
Okay, let's unpack this, because they beat on revenue, but they missed on earnings and margins dropped.
Right.
It's like throwing a highly successful party, but totally blowing the budget on the catering.
That's a great way to put it.
I mean, if the revenue is flowing, where is the profit leak? Is this a structural flaw or just transient noise?
Well, to figure that out, we really need to look at the velocity of their core business.
Okay, what metric are we looking at there?
Management highlighted their sequential flex revenue per billing day.
Okay, let's translate that out of Wall Street jargon for you guys listening.
Huh?
Sequential flex revenue per billing day basically means how much they are billing for temporary or flexible workers month over month.
Exactly. It is the absolute cleanest metric for tracking immediate demand momentum for their temporary workforce.
And what did that data show?
Total revenues saw a 3% sequential improvement.
Okay, that's solid.
But the divisional breakdown is where the real signal lies. Technology flex revenue grew 3% sequentially, and F&A flex revenue surged by 5.7%.
Wait, 5.7% sequentially? That's massive.
It is. And the transcript explicitly notes that the 3% sequential growth in the tech business is the highest sequential billing day growth they have seen since the second quarter of 2022.
Since 2022. So we're talking about the highest velocity of core tech demand in over 3 years.
It's a profound data point. It completely isolates the Q4 EPS miss from any narrative about weakening demand.
Right, because demand isn't weak at all.
Exactly. The demand profile is actually accelerating at a historic clip relative to recent years.
Okay, but this brings me back to my contradiction. We have a company billing at its highest velocity since 2022, yet their earnings missed the mark and margins dropped. That doesn't happen unless there's like a structural leak or a deliberate one-time anomaly. If it isn't a failure of demand, something massive ate the profits in Q4.
Well, the transcript breaks down the EPS miss into a confluence of 4 distinct factors.
Okay, hit me. What's the first one?
None of these reflect a deterioration in the core business, by the way. But first, we have to look at employee healthcare costs.
Healthcare? Really?
Yeah, so Kforce manages a massive pool of flex workers.
Right.
And they maintain self-insured elements within their benefit structure.
Okay.
In Q3 of 2025, they experienced abnormally low healthcare costs. Essentially, a statistical outlier in their favor.
I see where this is going.
Right. In Q4, that variance swung aggressively in the opposite direction.
So it's basically a calendar anomaly. They essentially had a backlog of medical claims hit the balance sheet all at once in the fourth quarter.
Exactly. According to CFO Jeff Hackman, the full-year healthcare costs landed exactly in line with their annual projections.
So it's just interquarter timing.
Which is notoriously difficult to forecast accurately. Q4 simply absorbed the brunt of that statistical normalization, which immediately dragged down the margin line.
Okay, so that totally makes sense for the healthcare hit. It's just noise, but what's the second factor?
Well, if they beat on the top-line revenue, what else do you think spiked?
Performance-based compensation.
Yep. You don't hit record velocity without triggering elevated commission tiers for the sales and recruiting teams.
Right, of course. You have a top-line outperformance, which automatically degrades the bottom-line EPS for that specific quarter because of the accelerated incentive structures.
It's the classic success penalty in a heavily sales-driven organization.
Honestly, as an investor, I'm completely fine with that.
Really? Even with a margin hit?
Yeah, absolutely. You gladly trade a few cents of short-term EPS to ensure your production engine is highly incentivized in closing deals.
That's fair.
But I know there were 2 other factors they cited, and those are what really caught my eye.
Yeah, the structural stuff.
Right. They took a 13-cent per share hit for a headcount and organizational restructuring.
Yep.
And on top of that, a $2.2 million write-off for an underperforming legacy software system.
Those 2 actions were significant drags on the Q4 bottom line.
Wait a second, though. If they are taking a $2.2 million software write-off in the exact same quarter, they are booking a 13-cent restructuring hit.
Yeah.
This isn't just bad luck with healthcare and high commissions. This is a classic kitchen sink quarter.
A kitchen sink quarter. Explain that for the listeners.
Corporate management teams do this all the time. When you have a quarter that is already facing a margin squeeze from timing anomalies like the healthcare thing, you use that quarter to take out all the remaining trash.
Oh, I see.
You clear the decks, you write off the old software, you pay the severance for the restructuring, and you just absorb all the pain at once so you can start the next fiscal year with a pristine balance sheet and lower operating costs.
That is an incredibly astute read of the corporate psychology at play here.
It's a classic move.
It really is.
Yeah.
And CEO Joe Liberatore actually framed the restructuring as a contrarian, proactive maneuver.
Proactive? How so?
Well, they didn't cut headcount out of desperation or declining demand. They executed these refinements because, after 3 years of macroeconomic fog, they finally have clear visibility and stability regarding market demand.
They finally see the shape of the recovery.
Exactly.
Because when you are stuck in a frozen market, you maintain excess infrastructure. You're waiting for the thaw, and you don't want to be caught understaffed when it happens.
Right, you hoard talent.
But once the thaw actually begins and the trajectory of the new normal becomes clear, you realize you don't need all that legacy infrastructure. You trim the organization to fit the exact specifications of the new growth cycle.
And that's exactly what they did. They aligned their support and delivery architecture directly to current revenue levels, while fiercely prioritizing the retention of their highest producing associates.
So keeping the rainmakers, cutting the fat.
Right. They are adamant that the organization retains more than enough capacity to absorb the surging demand without needing to bloat their internal headcount again.
So by packaging the software write-off and the restructuring into Q4, they basically engineered a vastly more efficient operating model for 2026.
Which means the Q4 EPS miss is, as you said, pure accounting noise. It is a manufactured reset.
Okay, so that completely changes the narrative on the EPS miss. It's actually a bullish setup.
It really is.
And that brings us to the core engine of this entire story. If the 3-year tech freeze is actually ending, we need to understand the catalyst. Why now?
Well, management leaned heavily into this concept of the AI reality check driving this historic demand.
The AI reality check. Let's dissect the psychology of their enterprise clients right now. What does that mean?
The transcript reveals a massive paradigm shift in how the Fortune 500 views artificial intelligence. For the past 2 years, the market has been completely gripped by an obsession with simplistic, consumer-facing AI.
Oh, yeah. Every boardroom was mesmerized by conversational chatbots and generative image models.
Exactly. The shiny objects.
Right. The tools that look incredible in a PowerPoint presentation, but, they don't actually optimize a global supply chain or secure a proprietary data lake.
Precisely. But we are now entering the era of complex corporate AI. And the painful realization that's sweeping through these enterprise C-suites is that you cannot simply purchase an enterprise AI license and overlay it onto a decaying, localized server architecture from a decade ago.
Yeah, you can't run a modern AI instance on unstructured, messy data. The AI will just hallucinate at scale. It's a disaster.
Exactly. These companies are realizing they have years of foundational IT debt that they've been actively ignoring.
And now the bill is due.
Exactly. They require rigorous data architecture overhauls. They need comprehensive digital makeovers. They have to execute massive cloud migrations and modernize their ERP systems just to get ready for AI.
So AI isn't the final step, it's forcing the first step.
Right. The CEO actually drew a brilliant historical parallel, mapping the current AI adoption cycle directly onto the emergence of the internet.
Oh, that's interesting.
Yeah, he outlined a 5-stage secular technology shift.
The internet analogy is perfect. Walk us through those stages because I think it completely demystifies the current spending patterns for you guys listening.
Sure. So stage 1 is initial exuberance, the hype cycle where everyone buys into the promise.
Like when ChatGPT first dropped.
Exactly. Stage 2 is massive infrastructure investment. Think of like laying fiber optics and building massive data centers.
Which is what NVIDIA and Microsoft have been doing.
Right. Then stage 3 involves the premature abandonment of legacy systems where companies aggressively try to pivot before they were actually ready.
Okay, and then?
Stage 4 is the harsh realization of integration and modernization needs. And finally, stage 5 is the return to balanced strategic investment and workforce transformation.
That stage 4 is the bottleneck. I mean, in the late 90s, companies bought the domain names and the routers, but then realized they needed an army of network engineers to actually make the systems talk to each other.
Right.
So management is signaling that we have just hit stage 4 for generative and agentic AI. The hype has collided with the reality of integration.
And Kforce referenced 2 highly specific pieces of external research from January to validate this exact view.
Okay, what were they?
The first was a Gartner report titled Dispel the Fear of AI Displacing Jobs, which concluded that a collaborative humans plus AI framework will significantly outperform AI alone.
Humans plus AI.
Yeah. The report asserts that this blended approach will become the dominant operating model for the foreseeable future.
Which completely vaporizes the narrative that AI is going to instantly replace the entire IT workforce. You still need the humans to guide it.
Exactly. And the second reference was even more telling. They cited a Wall Street Journal article highlighting a severe disconnect between CEOs and their actual employees regarding AI-driven efficiency.
Oh, I think I read that one, the one about operational friction.
Yes. That article exposed the friction of premature AI deployment. While CEOs believe AI is driving hyper-efficiency across their organizations, the employees actually utilizing the tools are reporting a vastly different reality.
What are they saying?
They're dealing with trust issues, massive accuracy problems, and significant amounts of rework. The time savings simply aren't materializing at the operational level yet.
Think about the psychological state of a Fortune 500 CEO reading that WSJ piece. You've authorized tens of millions in AI software spend, and your workforce is telling you it's causing more rework than it's saving.
Panic.
Total panic. You realize your foundation is cracked. Kforce's CEO explicitly noted that even with successful AI technology, 70 to 75% of the implementation success is dictated by human change management, socializing the tech, and prepping the data.
And that realization is exactly what triggers the demand for Kforce. These massive enterprise clients have internal workforces that are, as the transcript describes, completely tapped out.
Tapped out, meaning they spent 3 years running incredibly lean, right? Pausing hiring, and just squeezing every ounce of productivity out of their existing full-time employees just to navigate the macro uncertainty.
Exactly. So now, faced with this mission-critical backlog of data modernization and cloud migration projects required to make their AI investments function, they have no capacity.
Zero excess capacity. They cannot execute the roadmap internally.
So they are forced to look outward. They have to acquire highly skilled, flexible tech talent to bridge the gap.
Okay, let's look at the actual economics of that talent acquisition, because the transcript provided phenomenal granularity on their pricing power.
It really did. Chief Operating Officer Dave Kelly revealed that their average bill rate in the technology division has remained remarkably stable.
At what rate?
At approximately $90 per hour for the past 3 years.
Wow.
Furthermore, the finance and accounting bill rate has actually improved to roughly $53 per hour.
Okay, wait. A stable $90 bill rate across a 3-year tech recession. That is an astonishing indicator of structural labor scarcity.
It is. Usually in a prolonged downturn, you see immense downward pressure on pricing as staffing firms slash rates to maintain volume.
Right. Everyone discounts to win the business. The fact that Kforce held the line at $90 per hour proves that elite execution-level IT talent remains a highly scarce premium asset.
But we have to acknowledge the friction here, right?
What do you mean?
Well, you have enterprise clients waking up to massive data integration needs, but they're still carrying the psychological scars of a 3-year budget freeze. They are incredibly cost-conscious right now.
Oh, sure. Procurement is still breathing down everyone's neck.
Exactly. So how does Kforce maintain a premium $90 onshore bill rate, protect their own gross margins, and still win the business from anxious procurement departments?
That is the magic question. How do they do it?
That dynamic is the primary driver behind their aggressive expansion of their multi-shore and offshore delivery capabilities. Specifically anchored by their massive development center in Pune, India.
So it's an offshoring play. But this isn't just basic offshoring, right? The transcript pitched this as consulting-led solutions.
The architecture of the offering is brilliant, actually. Rather than supplying a client with a team of entirely US-based software engineers at maximum cost, Kforce constructs blended teams.
Blended teams? How does that work in practice?
They utilize robust US sales and senior delivery personnel. So the onshore architects who interface directly with the client's C-suite design the strategic roadmap and manage the project.
The face of the operation.
Right. And then they integrate them with highly skilled, immensely cost-effective execution pods based in Pune.
It perfectly solves the client's anxiety. I mean, the client gets a comprehensive enterprise-grade IT project completed at a blended lower overall cost. It fits their constrained budget.
Exactly.
But because the offshore talent pool operates at a significantly lower cost basis for Kforce, it actively expands Kforce's profit margins on the overall engagement.
Win-win. The COO explicitly confirmed this dynamic. He stated that these growing, consulting-oriented multi-shore engagements command higher overall bill rates at the project level and deliver significantly stronger margin profiles than standard onshore staff augmentation.
That's huge.
It acts as a structural defense mechanism against rate pressure. It allows them to enhance their margin profile even when clients are trying to compress costs.
And they noted a marked acceleration in demand for these offshore offerings over the last few months, right?
Yes, a very clear acceleration.
Because it is the exact product the market needs right now. high-end technical execution with a budget-friendly blended rate.
And this multi-shore strategy ties directly into another behavioral shift highlighted in the transcript.
Which is what?
The distinct preference for renting talent versus buying it. Joe Liberator discussed the conversion rates, noting that fewer enterprise clients are converting Kforce consultants into permanent, full-time employees, or FTEs.
Okay, now that is fascinating. For you guys listening, historically, a massive chunk of a staffing firm's margin comes from those conversion fees.
Huge chunk, yeah.
Like, a client rents a database architect for 9 months, loves the work, and pays a hefty premium to bring them in-house permanently. If conversions are down, the initial reaction might be concern.
You would think so. However, in the current macroeconomic climate, lower conversions are actually reinforcing Kforce's core flex revenue stream.
Because the clients are paralyzed, right? Paralyzed by the long-term implications of AI on their workforce architecture. They have no idea what their permanent IT org chart should look like 3 years from now.
Exactly. They are terrified of making fixed cost commitments. Hiring a permanent FTE means absorbing benefits, healthcare, severance risk, and massive structural overhead.
They just want total agility.
Yes, they want the ability to spin up a 50-person data migration pod for a 12-month sprint and then immediately scale that cost back to zero without a single layoff.
That demand for absolute frictionless agility is the ultimate moat around Kforce's business model. The fear of making an incorrect permanent hiring decision in the shadow of AI adoption is actively driving the Fortune 1000 right into the arms of flexible staffing providers.
The CEO actually posed a rhetorical question on the call about this. He asked, will the overarching concern of, I don't want to hire permanent people because AI may eventually displace them, naturally create more structural demand for flexible work models?
And the data suggests it already is.
It absolutely is.
So, synthesizing everything we've pulled from the ledger so far, the top-line velocity is accelerating at the fastest pace since 2022.
Yep.
The EPS miss was a manufactured kitchen sink quarter, clearing the way for 2026. The AI data readiness backlog is immense. The multi-shore strategy is protecting margins, and the enterprise preference for renting talent is locked in.
That's the setup.
With that foundational understanding, we need to examine what management is guiding for the immediate future. Let's move to Section 3, guidance.
Okay, so CFO Jeff Hackman provided robust guidance for the first quarter of 2026.
Give us the numbers.
They are projecting Q1 revenue to land between $324 million and $332 million.
Okay, considering Q1 is historically a seasonally slower quarter, hitting the high end of that range at $332 million would represent actual year-over-year revenue growth.
It would. And even the low end signals a flattening out of the massive declines we saw in the previous years.
The bleeding has stopped. What about the bottom line?
They are guiding for Q1 EPS between 37 cents and 45 cents.
But there is a massive caveat baked into that EPS projection that requires translation, right?
Yes, there's a big one.
They are modeling a severe tax headwind.
This is a critical component for anyone modeling the stock's future cash flows. Management disclosed that their effective tax rate is structurally jumping to 29% for Q1.
29%.
Yes, and likely maintaining that elevated level throughout the entirety of 2026.
To put that in perspective for you listening, their effective tax rate in 2025 was 26%.
Right.
A 300 basis point increase on the tax line is a heavy anchor on net income. Did the corporate tax code change, or is this specific to Kforce's internal accounting?
It is driven by a combination of expiring federal incentives and the maturity curve of their internal capital expenditures.
Okay, break that down.
The first major hit is the expiration of the Work Opportunity Tax Credit. This was a federal program that incentivized massive employers like Kforce to hire individuals from targeted demographics who face systemic barriers to employment.
Okay, that makes sense.
Kforce heavily utilized this credit, but the legislation was not extended into 2026, instantly removing a structural tax advantage.
So it's a purely legislative expiration. Out of their hands. What is the second factor driving the rate up?
The mechanics of research and development tax credits, specifically tied to their internal software infrastructure. Kforce has been executing this massive multi-year transition to Workday, integrating it as their foundational enterprise cloud application for human capital management and financials.
Oh, Workday. Workday is an absolute behemoth of an implementation. It takes years to configure and deploy across an enterprise of Kforce's scale.
It does. And the federal tax code incentivizes companies undertaking these massive internal R&D and modernization projects by offering tax credits based on the annual capital expenditure.
Right. The more you spend on R&D, the bigger the credit.
However, because Kforce is now progressing into the later, more mature stages of the Workday deployment, their year-over-year capital spend on the project is actively decreasing in 2026 compared to 2025.
Ah, I see. The math turns against them. Because they are spending less money on the implementation, the associated R&D tax credit they are legally allowed to claim shrinks proportionally.
Exactly. They're essentially experiencing a tax penalty as a direct result of efficiently winding down a major capital expenditure.
That's ironic.
It is. When you combine the loss of the work opportunity tax credit with the shrinking R&D credits tied to the Workday project, alongside some higher non-deductible compensation elements, the effective tax rate mathematically resets from 26 to 29%.
This highlights the absolute necessity of dissecting the transcript rather than just reading the headline guidance.
It really does.
I mean, if an algorithm or a passive investor just scans the Q1 EPS projection, it less artificially suppressed. They might assume the core profit engine is stalling.
Right. But in reality, a massive chunk of that margin pressure is purely legislative and administrative. It has absolutely zero correlation to the velocity of client demand for IT staffing.
Zero correlation. And if you strip away the tax mechanics and focus purely on management's commentary regarding demand, the tone is arguably the most bullish we have heard in years.
It really is. Yeah. We need to extrapolate on the specific language Joe Liberatore used to describe the start of 2026.
The language was incredibly aggressive. He didn't just say things were stabilizing. He explicitly stated that January 2026 was their best start since 2022.
He further contextualized that by noting client visits, the leading indicator where enterprise decision makers actively request meetings with Kforce to scope out upcoming project architecture, are currently at historic highs.
Historic highs?
He literally stated they are at the highest levels he can recall in his entire tenure.
That is a staggering metric, not just a recovery from the 2023 lows, but historic all-time highs in top-of-funnel client engagement.
And he pointed out a distinct aberration in standard seasonal behavior too.
What happened?
Normally, Q1 begins with a pronounced lull. January is sluggish as enterprise budgets go through final approvals and personnel slowly return from holiday PTO.
Right, standard corporate sluggishness.
But he noted that this year, the pipeline activated instantly. Order flow and project greenlights surged right back to pre-holiday peak levels the moment the calendar turned.
Wow.
The pent-up demand was so severe that clients basically bypassed the traditional January budgeting hesitation entirely.
Which forces us to look at the operational leverage of the firm. If demand is flooding back into the system with historic ferocity, how efficiently is Kforce positioned to convert that top-line surge into bottom-line cash flow?
This is where the brilliance of the Q4 restructuring we talked about earlier materializes.
Ah, the kitchen sink.
Yes. The CFO detailed that the headcount and organizational refinements executed in the fourth quarter will yield approximately $7 million in permanent annualized structural savings.
$7 million stripped out of the fixed cost base.
Which translates to roughly 30 cents per share in annualized operational efficiency.
Think about the math on that maneuver for a second. They absorbed a one-time 13-cent hit in a messy Q4 to permanently extract 30 cents of cost per share every single year going forward.
It is a masterclass in capital allocation.
It really is. The leverage this creates is immense.
It is. The CFO confidently stated that due to these structural cost reductions, Kforce expects to expand operating margins in 2026, even in a scenario where macroeconomic revenue trends remain completely flat.
They have engineered a scenario where profitability grows even if the top line stagnates.
Exactly.
And based on the historic client visits and the January surge, the top line isn't going to stagnate. If revenue accelerates into this newly optimized, leaner cost structure, the margin expansion will be explosive.
Management actually reiterated their ultimate cyclical target. They want to achieve an approximate 8% operating margin when annual revenues scale back to the $1.7 billion threshold.
Okay, let's contextualize that. They are currently sitting at $1.3 billion.
Right.
But the critical context is that the last time Kforce generated $1.7 billion in revenue back in 2022, their operating margins were significantly lower.
Yes, much lower.
They utilized the 3-year macro freeze to fundamentally rebuild the engine. They expanded the high-margin multi-shore Poon Center. They grew the consulting-led solutions, and they ruthlessly trimmed legacy overhead.
And when the macroeconomic water level eventually rises back to 1.7 billion, they will be vastly more profitable than they were at the previous peak.
It is the defining characteristic of a highly disciplined management team navigating a cyclical trough.
I couldn't agree more.
All right, we have dissected the revenue velocity, deconstructed the Q4 accounting anomalies, mapped the AI-driven data modernization backlog, and analyzed the margin leverage created by their structural cost cuts.
We've covered a lot of ground.
We have, but now it is time to fulfill the Talk Ticker's mandate and deliver a definitive verdict for the retail investor. The bottom line. Is this transcript flashing a bullish or bearish signal?
Synthesizing the entirety of the data, the signal is aggressively bullish.
Aggressively bullish. I completely agree.
I mean, if an investor allows themselves to be distracted by the superficial Q4 EPS miss or the transient tax rate adjustments, they are missing the profound underlying shift in the core business. The 3-year macroeconomic freeze on enterprise IT spending is demonstrably thawing.
The ice is breaking, and Kforce is perfectly positioned to capture the resulting flood. But let's give the listener the actionable financial health indicators.
Okay, let's do it.
If you are holding KFRC or evaluating an entry position, what fundamental metrics validate this bullish stance, proving the company can actually sustain operations while waiting for the full macro recovery to materialize?
The primary indicator of their financial resilience is capital efficiency. Despite operating in an environment where full-year revenue contracted by 5%, Kforce maintained a return on equity, or ROE, of approximately 30%.
Wow. Sustaining a 30% ROE during a revenue contraction is a testament to pristine capital management. What about their liquidity profile?
The cash generation remains robust. They produced $19.7 million in operating cash flow in the fourth quarter alone.
And crucially, how is management deploying that capital?
They are aggressively prioritizing shareholder returns. The board of directors authorized another increase to the dividend, marking the 7th consecutive year of dividend hikes.
Okay, a board does not authorize a 7th consecutive annual dividend increase if they are harboring internal concerns about the structural viability of their cash flows.
Never.
It is the ultimate signal of forward-looking confidence.
And beyond the dividend, they're actively managing the float through substantial share repurchases. During Q4, Kforce deployed approximately $7.4 million to buy back their own stock.
Nice.
CFO Jeff Hackman explicitly stated their intention to continue funneling any excess cash generated beyond what is required for operational capital expenditures and the dividend program directly into ongoing share repurchases.
That dynamic is vital for retail investors to internalize. Shares on the open market, mathematically increasing the equity value and earnings power of every remaining share.
Yep, math is on your side.
But more importantly, it establishes a psychological floor under the valuation. Management is signaling to the broader market that they view their own equity as mispriced and are willing to deploy millions in free cash flow to acquire it at current levels.
It demonstrates total alignment between management's capital allocation strategy and long-term shareholder value creation.
There was one final nuanced observation in the Q&A session that perfectly encapsulates the dual-engine nature of this impending recovery. It centers on the direct hire business.
Ah, the permanent placement division.
Yes, which we noted earlier was seeing suppression among the massive Fortune 1000 clients who prefer renting talent due to AI uncertainty.
Exactly. The massive enterprises are clinging to flex labor. But Joe Liberatore highlighted a fascinating countertrend. He noted that small to mid-sized businesses have actually become markedly more active in executing direct permanent hires.
Small and mid-sized businesses are hiring FTEs.
Yes. The underlying logic is that these smaller organizations have operated with such severe skeleton crews over the last 3 years that they have literally exhausted their capacity to function.
They can't bleed anymore.
Exactly. They are forced to backfill and add permanent staff simply to maintain baseline operations and prepare for any semblance of growth.
It creates a beautifully balanced recovery model. The small and mid-sized businesses provide a steady, stabilizing baseline of direct hire revenue as they rebuild their depleted ranks.
Right.
And simultaneously, the colossal enterprise clients provide explosive, high-velocity demand for the flexible, multi-shore consulting business as they panic buy the talent required to build their AI infrastructure.
Framing all these elements together, Kforce represents a prototypical early cycle recovery asset.
They are the infrastructure play. Instead of using the tired picks and shovels analogy, think of Kforce as the heavy machinery crew paving the digital highways.
I like that.
I mean, the entire market is obsessed with the sleek, high-speed sports cars, the generative AI models, the LLMs, the autonomous agents. But none of those sports cars can actually drive anywhere until the highway is paved, the data lakes are structured, and the cloud architecture is resilient. Kforce is supplying the engineers who are physically pouring the concrete for the enterprise AI highway.
And based on the historic client visitation metrics in January, the Fortune 500 has realized their roads are unpaved and they are lining up to hire the construction crews.
We promised a comprehensive extraction of the actionable intelligence from this transcript, and we have delivered.
I covered it all.
We bypassed the accounting noise of the Q4 margin squeeze to reveal the underlying acceleration in sequential flex revenue. We mapped the AI reality check, forcing enterprises to finally modernize their foundational data architecture.
We analyzed the Poon strategy, protecting gross margins.
And we outlined the sheer operational leverage management has engineered for the impending recovery. KFRC is a cash-generating, highly efficient entity standing directly in the path of a massive enterprise spending wave.
The data dictates a compelling, empirically supported narrative.
Before we close the ledger on this deep dive, I want to leave you, the listener, with a final provocative concept to mull over. Something that reframes the entire AI investment landscape based on the realities we've discussed today.
A shift in perspective.
Exactly. Right now, trillions of dollars of speculative capital are frantically searching for the next pure-play AI software company or the next hidden semiconductor manufacturer. The market is exclusively focused on the technology itself.
Right, everyone's looking at the chips and the code.
But consider the industry data explicitly cited by Kforce's CEO. 70 to 75% of the ultimate success or failure of any AI deployment is dictated by human change management, data preparation, and workforce behavioral adaptation.
The bottleneck is inherently human, not algorithmic.
Precisely. So the question you have to ask yourself as an investor is this. If the single greatest obstacle preventing the Fortune 500 from realizing their AI ambitions isn't the software, but rather the severe scarcity of human capital required to integrate and manage it, are legacy, flexible IT staffing firms actually the most mispriced and undervalued AI infrastructure play currently available on the public markets?
It is a profound thesis that the broader market has yet to fully price in.
Let that dictate your research this week. Thank you for joining us for this massive expansion of the Talk Tickers format. We will see you on the next deep dive.